Another measure of affordability is rental yields, that is, the rent from the property divided by the price of the property. The exhibit below shows that 2.4% Indian rental yield is among the lowest in the world. A 2.4% rental yield means that for a property worth of 1 crore rupees, the annual rent that the house owner gets is rupees 20,000 per month or rupees 2.4 lakh per annum. While commercial rental yields have always been higher, residential yields have been traditionally lower because of an inbuilt expectation of property appreciation. This also has to be seen in the context of underlying interest rates in the countries. For most developed countries, rental yields are far higher than their policy or 10-year government bond rates. In India, it is the reverse. 10-year bond yields vary in the range of 6 to 7% in India compared to 2.4% rental yield. Exhibit 39, Indian rental yields are amongst the lowest in the world, 2016. Almost by any yardstick, the residential property market in India is significantly overvalued. Some of the micro markets are stretched to a bubble proportion. Today, a small house in the suburbs of Mumbai costs anywhere between 1.5 to 2 crore rupees. The equivalent monthly installment for a loan that amounts is roughly 1.5 to 2 lakh rupees per month. To be able to afford rupees 2 lakh EMI, a professional has to earn at least 3.5 lakh rupees per month. This corresponds to a pre-tax salary of about 60 lakh rupees per annum. As per the income tax returns filed for FY17, there are only 1.7 lakh people in the country earning more than 50 lakh rupees per annum. So it is not clear who exactly will buy these tens of thousands of flats in the suburbs of Mumbai, New Delhi, or Bangalore. Not surprisingly, prices have already corrected. As can be seen in the exhibit below, prices have come down significantly in a few cities and have stagnated for other cities except Navi Mumbai and Hyderabad. Even for Navi Mumbai, the annual compounded return is only 5.2%. This compares with Sensex annualized return of 12% in the same period, September 2013 to March 2017. Exhibit 40, price change in the last 4 years, absolute. In spite of a significant decline in the number of new launches, see Exhibit 41, sales have been sluggish and have led to massive inventory built up across all cities in India, with the situation most acute in the national capital region. On an average, at the current compensation consumption rate, it will take 11 years just to clear the inventory. Exhibit 41, new launches have come down significantly. Exhibit 42, the inventory pile up in the residential real estate. Portfolio allocation. Does it make sense to invest in real estate? Having understood all this, you have to ask yourself, does real estate deserve a place in my portfolio? We have seen in isolation the answer is an emphatic no. Let us look at the only other plausible reason. Does it offer diversification? It is established wisdom to have a diversified portfolio because it brings the volatility or risk of the portfolio down without compromising returns significantly. It is worth going into a bit of asset allocation theory at this point to understand how diversification works. When two asset classes are mixed in a portfolio, while the combined performance is a weighted average of the performance of two underlying assets, the combined risk is not such a straightforward calculation. Typically, the combined risk is lower than the weighted sum because some risks cancel each other. Thus, diversification offers the same return with lesser risk. However, as the eagle eyed reader would have figured out, diversification only works if the asset classes are less than perfectly correlated with each other. If both asset classes behave in a very similar manner, then the diversification of risk simply does not happen. For example, adding bonds to your equity portfolio reduces your risk significantly without a proportionate reduction in returns. However, buying a stake in private equity fund does not reduce your risk in a meaningful way because the prices of both asset classes, that is equity and private equity, move in a similar way. Given that backdrop, let us now study the correlation between equity and real estate. Given the lack of data in the Indian milieu, we again looked at data in the US. The long term correlation between Dow Jones and US property, as measured by Robert J. Schiller's Real Home Price Index, was a staggering 78%, implying that American stock markets and American real estate prices more or less move in sync. In comparison, according to consulting firm Aon Hewitt, the long term correlation between US equity and bonds is around zero. Advice for Mr. Talwar and Mr. Sanghvi: there is no denying that real estate had a great run until 2013, but one has to remember that part of it was to make up for decades of no price appreciation, and part of it was a bubble building up. We have learned from the global experiences that real estate has long cycles of boom and bust. Sitting in the comfort of Ambit House in August 2017, a correction in Indian residential real estate appears inevitable. Even if prices don't crash, it is quite unlikely that they will go up in a meaningful manner, a phenomenon that Indian investors politely call time correction. Mr. Talwar and Mr. Sanghvi, meanwhile, will have to throw their preconceived notions regarding real estate out of the window if they want to have any hope of generating a healthy post-tax return that can give them a corpus to support their families. We shall delve into this in greater detail in penultimate chapter. The three key takeaways from this chapter: number one, in India and developed markets, real estate has given far lower returns compared to equity over longer period of times. Along with that, its high correlation with equity means that real estate offers little way of diversification. A combination of these two factors remains that means that this asset class does not really deserve a place in most investors' portfolio. Number two, real estate is the most illiquid asset with the highest transaction costs, which are now in excess of 10%. Furthermore, unfavorable taxation compared to equities make it even less desirable for investment. Number three, India has had a once in a lifetime bull run in real estate between 2003 and 2013. However, this took the prices of residential real estate into bubble territory and, just as importantly, out of bounds for the vast majority of end users. Even if there is no drastic fall in prices, a time correction is imminent, implying many years of poor price performance. Chapter 5: Small is Beautiful. At the end of the day, small business success should just be a way station on your way to large business success. Lloyd Blankfein, CEO Goldman Sachs. How Indians fell in and out of love with stocks. It was between 1990 and 1995 that retail investors in India fell in love with stock market investing for the first time. This period started with the BSE Sensex quadrupling in less than 20 months. From 1000 points in July 1990, it crossed 4000 points in March 1992, supported by the liberalization of economic policies triggered by the PV Narasimha Rao led Congress government. Investors' love for the stock market was such that the number of retail investment folios that existed in 1995 was more than the number today. The effect of this investor interest was also reflected in IPOs. During 1992 and 1996, around 4,000 companies went public, implying around 4 IPOs per day. In 1989 to 1990, stocks were trading at price to earning multiple of 1x, 2x, and 3x. Some stocks were even trading below earnings. By 1994, I thought I knew stock market investing because of the multi-bagger that I had made between 1989 to 1994. Then 1994 to 96 turned out to be very testing years. Once you have had a 30 bagger, that is a stock which goes up 30 fold, inevitably, if you are an equity investor, you will get drunk and make a set of mistakes. These mistakes pushed our portfolio into very bad shape by 1996. We lost a lot of money because I had not realized that what had happened between 1989 and 1994 was a one time event. Basically, we had reaped in those years the fruits of liberalization and were lucky to be in the right place at the right time. Sankaran Narain, CIO of ICICI Prudential Mutual Fund. The 1990s euphoria also coincided with a period when the stock market was one of the preferred avenues for deploying black money for thousands of households. Most IPOs in the decade were orchestrated by fly by the night operators working in cahoots with shady brokers, some of whom ended up behind bars. Although the SEBI had been set up in 1992, pricing controls had been removed. That, combined with the lack of paper regulations and infrastructure, facilitated fraudulent activities by operators. For example, offer documents used to be 6 to 8 pages long in those days versus over 500 pages now, since SEBI did not require too many disclosures. Defaulting promoters and those against whom regulators had passed orders were not barred from launching another IPO. Those days, almost all issues were aimed only at retail investors versus 50% reservation today for qualified institutional buyers who more often than not became part time venture capitalists taking huge risks. The scandals of the early 1990s prompted the SEBI to initiate a cleanup of stock market practices from 1996. The most critical of these measures was the dematerialization of shares, that is, a shift to electronic share certificates from physical share certificates. This development curbed a range of malpractices which hinged on duping investors with forged share certificates. Unfortunately, this positive regulatory change had a massive adverse impact on retail inflows into the stock market over the next 20 years. For 2 decades after this momentous change in 1996, Indian investor routed their black money savings away from the stock market and towards real estate and gold. By 2013, property prices in Mumbai started rivaling those in London and New York suburbs, and Indians became the world's biggest buyers of gold. Rental yields in India's residential property markets are now amongst the lowest in Asia. See Exhibit 39 in Chapter 4, thus pointing to significant overvaluation of this asset class, mainly because it can absorb black money. Exhibit 43, domestic equity mutual fund flows in India have been weak post 1996. This chart shows net inflows, that is, inflows net of outflows. Whilst official figures are not available to quantify the size of the black money, research conducted by analysts at Ambit Capital suggests that more than 30% of India's real estate sector is funded by black money. The retail investor returns to the stock market. However, there has been a trend reversal in investors' choice of asset classes since 2015, the year in which the NDA launched its multi pronged attack on the black money. As quoted in Ambit Capital's July 2015 report on the crumbling of the residential real estate sector, we are seeing a broad based real estate pullback with price correcting in the most tier 1 and tier 2 cities alongside sharp drops in transaction and new launch volumes. The drivers for this slowdown are a mix of supply side factors and demand side factors. The NDA's success is dramatically reducing the flow of black money seems to have been centered around moving India's subsidy and benefit system to direct benefit transfer. The Indian government disburses subsidies and benefits worth 4% of GDP or rupees 6 lakh crore, that is 100 billion US dollars. In the past, at least half of this amount was stolen or pilfered by politicians and civil servants who would use this money, which had now become since it was stolen money, to invest in land, real estate, and jewelry. Within 3 months of being elected Prime Minister in May 2014, Narendra Modi promised to move India's subsidy and benefit system to direct benefit transfer, that is, a direct transfer of 4% of the GDP from the government's bank accounts to the recipient's bank accounts. He then took steps to implement this policy announcement and thus significantly reduced the amount of stolen or black money in the hands of civil servants and politicians. Demonetization. On 8th November 2016, the government demonetized 86% of the country's total currency in circulation. This resulted in the forced deposit of over 15 lakh crore rupees, that is 230 billion US dollars, or 10% of the GDP, into the banking system, of which a sizable portion is likely to have been black money. The Real Estate Regulatory Act (RERA). This act came into effect on May 2017. Over the last 2 decades, gullible real estate customers have fallen victims to the builders who have not felt the need to ensure transparency, accountability, and sound business practices. Their modus operandi was booking profits on the back of substandard construction materials, acquiring and building on plots which do not have clear title and or developing permissions, and ignoring local development rules. These builders were also the ones who accepted unaccounted cash, thereby cheating the government of stamp duty and registration revenues. RERA imposes a range of rules and obligations on the builders aimed at increasing transparency and accountability, which will make it harder for builders to either shortchange the buyers or to use black money. For example, developers have to put 70% of the funds collected from buyers in a separate account to meet the construction cost of the project, rather than the erstwhile practice of diverting these funds for other purposes such as land acquisition. Goods and Service Tax. The introduction of GST in July 2017 should increase tax compliance across the country, as those who do not comply will find it difficult to get customers. Why? Because in the post GST world, the buyer of any good or service pays GST at a point of purchase and then get an input tax credit, which he as a seller reports as expenses. In such a world, if any buyer does not report his purchases, he fails to get the input tax credit and therefore ends up with a higher effective tax burden. Thus, the GST creates a massive incentive for economic agents to avoid having any commercial dealing with the tax evaders. Consequently, since 2014, investors have become cautious of investing in residential real estate, leading to a stagnation or reduction in the prices of real estate across the top metropolitan cities. Left with no better choices, affluent Indians are rediscovering the delight of the stock market. The annual run rate of gross inflows from retail investors in India has risen from 48,154 crore rupees, that is 7.5 billion US dollars in FY14, to 2.5 lakh crore rupees, that is 39 billion US dollars in FY17, an annualized growth rate of 73%. More generally, net inflows from retail investors to all types of mutual funds have risen to 54,083 crore, that is 8.5 billion US dollars in FY14, to 3.5 lakh crore rupees, that is 53.7 billion in FS17, an annualized growth rate of 85%. Exhibit 44, there is an increase in mutual fund investor accounts from 3.95 crore in September 2014 to 5.82 crore in June 2017. The active diversion of savings from physical form towards the financial form has increased the corpus of bank deposits, bond outstanding, and market cap of the market. The exhibit below shows this trend. Given the bank deposits are the cheapest source of capital for any bank, a structural rise in the bank deposits is likely to lead to a reduction in the rate at which banks lend money. Exhibit 45. Household financial savings are surging in India. Small caps outperform large caps for different time periods across the world. As a generation of affluent Indians venture into the stock market, they are going down in the market cap spectrum in the hunt of better returns. See exhibit below. Hence, it is worth estimating the potential of smaller companies to outperform larger companies. Exhibit 46. Small and mid cap mutual funds in India have seen significant gross inflows between 2014 and 2017. Across the world and across various time periods, small caps have outperformed large caps in most stock markets. For example, as seen in the exhibit below, the outperformance of small caps over large caps for rolling 5 years compounded annualized return from 1998 to 2004 has been 5% in the US, while the same has been 4.6% in the Asia Pacific region, including Japan. In particular, more often than not, small caps have outperformed large caps in various countries over the past decade. See exhibit below. Exhibit 47. Small cap indices outperform large cap indices in rolling 5-year CAGR. The x axis indicates the start date of the 5-year period. Exhibit 48. Annualized outperformance of small caps over large caps over 2000 to 2013. However, over a long holding period, 30 to 40 years, neither the US nor the Asia Pacific ex Japan indices have shown a meaningful outperformance of small cap over large cap. The outperformance of 39-year CAGR from 78 to 2017 for the US small cap Russell 2000 over US large cap Russell 1000 has been only 0.8%. In fact, Asia Pacific ex Japan small cap index has underperformed large cap index by 0.6% negative between 1995 and 2017. In India, as can be seen in the exhibit below, there have been prolonged phases of outperformance of small cap stocks over large cap stocks. The longest such phase of the past decade lasted from 2013 to 2017. For this comparison, we have used the BSE 100 index as a benchmark for large caps and BSE small cap index as a benchmark for small caps. In India, as can be seen in the exhibit below, there have been prolonged phases of outperformance of small cap stocks over large cap stocks. The longest such phase of the past decade lasted from 2013 to 2017. For this comparison, we have used the BSE 100 index as the benchmark for large caps and BSE small cap index as the benchmark for small caps. Note, the BSE small cap includes 768 stocks with a median market cap of rupees 1600 crores. Over the past 8 years, that is 2009 to 2017, the BSE Small Cap Index has beaten the BSE 100 by 4.6% per annum. Exhibit 49, 1 year rolling returns of the BSE Small Cap Index minus the BSE 100. Why should a portfolio of great small caps outperform the broader large cap universe? This question can be answered in two ways. Smaller companies have the potential to grow their profits much faster than the large companies, and secondly, as small companies grow, they are discovered by the stock market. That is to say, successful small caps gradually attract more research coverage from brokerage and analysts and therefore attract more interest from institutional investors with deep pockets. Let's look at each of these two effects given their relevance in contemporary India. First is small cap companies grow faster. Fundamentally, small cap companies profit grow faster than large caps, particularly in periods when credit availability is plentiful, economic growth is accelerating, and there are ample undervalued valued competitors, listed or unlisted, that can be acquired. When M&A take place at reasonable valuation and with the aim of taking synergy benefits, they are share price accretive. High valuations and forays into totally different businesses destroy value. Conversely, small caps tend to underperform when these conditions are reversed. These conditions are reversed. Small caps' outperformance on fundamentals can also be supported by the presence of complacent large caps in an industry undergoing disruption or ecological changes which redefine the framework of competitive advantages for that industry. Ralph Wanger, founder of Chicago's Wanger Asset Management, is in his insightful book A Zebra in Lion Country, calls the phenomena Darwinism in the marketplace, which implies that in any environment, some creatures are going to be more successful in adapting than others, and those adaptable creatures are the ones that will thrive and prosper. Ambit Capital's research shows that in India, the average probability of a sector leader Ambit Capital's research shows that in India, the average probability of a sector leader, defined as companies that featured in the top quartile on Ambit Capital's greatness framework in their respective sectors, remaining a sector leader 5 years later, is only 15%. This implies that 85% of the BSE 500 companies slide towards mediocrity within 5 years of achieving greatness. In fact, the average probability of a great company actually becoming a sector laggard 5 years later is 25%. In fact, the average probability of a great company actually becoming a sector laggard 5 years later is 25%. In most cases, such slide into mediocrity is caused by hubris and arrogance amongst the management and promoters of a large successful company. When a company is on top of its game with record operating profits and dizzy valuation multiples, success and adulation intoxicates the top brass. Arrogance sets in, and the company loses sight of the factors which made it successful for the first place. On the other hand, owners and managers of small companies, often they are the same person, are hungry to grow, hungry to achieve greatness and all the perks which come with it. They tend to be intensely driven and, unlike large companies, do not have to go through layers of management hierarchy in order to respond to changes in the business environment. This helps smaller companies consistently grow profits faster than large companies. Number two, small cap companies get discovered. More often than not, small cap firms suffer from the neglect because they are not in the news and are not covered by major brokerage house. Consequently, investors are simply not aware of what is happening in these companies. Brokerages which publish research on listed stocks are one of the biggest sources of company specific information for investors. Small caps have significantly less sell side coverage than large caps as shown in the exhibit below. Exhibit 50, median analyst coverage per stock, sell side analyst coverage dwindles with size. Besides coverage by brokerage analysts, institutional investors' policies around liquidity or size may prevent them from allocating money to small cap stocks in a meaningful way. Thus, brokerages cannot generate enough revenues from institutional trading commissions on small caps. Lack of such potential revenues diminishes their incentive to provide broad research coverage of small caps, creating a lower level of market efficiency. For instance, within the apparel industry, a stock like Keval Kiran Clothing, with a market cap of 2010 crore rupees in July 2017 and a 26% free float, will have far less information flow and market attention than a stock like Page Industries that has a market cap of 18,825 crore rupees and a 49% free float. As per Bloomberg, only 7 sell side analysts cover Cable Kiran clothing stock compared to 15 analysts covering Page Industries. It is no surprise, therefore, that Page Industries' share holding has 42% institutional investors, whilst Cable Kiran has only 21%. Globally, around 20% of the small cap stocks do not have any sell side coverage. Finally, the greater number of small cap stocks compared to the number of large cap stocks makes it difficult for sell side brokerages to cover the small cap universe. As shown in the chart below, the total number of small cap stocks listed in India is more than 10 times that of mid caps and large caps. Exhibit 51, the number of companies in the small cap universe is significantly higher than those in the large cap and mid cap universe.